I was looking at the market data this morning, just scanning the usual sovereign bond yields, when I saw something that made me think my screen was actually broken. I honestly had to refresh the page twice, just to be sure.
Yeah.
There, in black and white, was a crossover that hasn't happened since we started keeping records back in the year 2000. For decades, the financial narrative in Asia has been ironclad. Japan is the frozen economy, the land of lost decades and zero interest where prices never move. And China is the furnace, the unstoppable high-growth engine of the world. But right now, that script isn't just flipping, it's being shredded. We are seeing a historic anomaly where the 10-year Chinese government bond yield has dropped below Japan's. Think about the irony of that. You have Japan, the poster child for stagnation, suddenly handing out stimulus checks and seeing inflation hit 3%. Meanwhile, China is sliding into the very trap Japan just escaped, with 70% of household wealth locked in crumbling real estate and prices actually falling. Money is fleeing into bonds for safety. It's a complete inversion of reality. Markets are screaming that the Japanification of China isn't just a theory anymore. It's mathematical.
It is. That yield inversion, China at roughly 1.83% and Japan a tick higher at 1.84%, it's the most potent symbol of this seismic shift.
It's incredible.
It tells us that investors, in real time, perceive the structural risk, the immediate threat of stagnation, to be higher in the high-growth furnace that was China than in the perpetually frozen economy of Japan.
And that's exactly why we need this deep dive. Our mission today is to really unpack what this inversion means on a structural level. We need to compare China's intensifying crisis, the debt, the demographics, the deflation to Japan's decades of struggle, analyze the vastly different policy paths these two giant economies are now taking, and critically assess what those paths mean for the rest of the world and for your investment portfolio.
This is truly a real-time economic role reversal. And it forces us to shift our analysis entirely. We are moving away from hypothetical stagnation models for China to, hard, tangible evidence of deflationary fear.
And on the other side?
On the other side, you have this tentative, perhaps even nascent, recovery pulse in Japan. It's a dynamic shift that is going to define Asia economics for the next decade, I think.
Let's start with the cold, hard reality hitting China, because that 1.83% bond yield, it's the result of fear, not fundamental strength. What does the data tell us about China's descent into a true deflationary cycle?
The quantitative proof, it points to a deep structural freeze, and it has been accelerating. When we look at the September data, the Consumer Price Index, the CPI, what consumers pay for goods, it fell 0.3% year on year.
That's not enough.
It is, but the truly alarming metric is the Producer Price Index, or PPI. That fell 2.3% year on year.
That PPI figure is the tell, isn't it? It really reflects the press war happening at the factory gate.
It absolutely is the clearest sign of internal stress. This descent places China in its longest deflationary cycle in the industrial sector since the late 1970s. We've now seen 34 consecutive months of PPI decline.
34 months.
Think about that. Nearly 3 years of sustained factory gate prices falling. This is not a temporary dip. It's a clear symptom of severe overcapacity. Factories producing way more than can be absorbed, coupled with critically weak demand.
Both at home and abroad.
Both domestically, because households are nervous, and internationally due to all the geopolitical friction.
And this demand freeze, it leads us directly back to that bond yield. That tiny 1.83% return isn't a sign that investors are excited about China's fiscal health.
Not at all.
It's a symptom of absolute panic in the broader asset markets. It's the ultimate flight to safety.
Precisely. Money is fleeing assets that have proven volatile or, outright destructive. The primary culprit, which we cannot overstate, is the crumbling real estate market. The data is dire.
What are we seeing there?
Prices for new homes in 70 major cities fell 0.5% month-on-month in October, and that was actually worsening from the previous month's figures.
And the reason this hit so hard in China, unlike previous global housing busts, is the sheer concentration of wealth, right?
Exactly. Over 70% of Chinese household wealth is tied up in property. Compare that to roughly 50% in Japan back in 1990, and less than 35% in the U.S. When that asset class contracts, the vast majority of the population feels the pain immediately.
And that pain, that fear, it translates directly into a rush into government bonds.
Out of sheer necessity. It's a complete lack of trust in alternatives. You accept a ridiculously low yield because you prioritize capital preservation above all else.
To make this macro data tangible, we have to look at the human cost. I was reading about someone like Li Hui, an architect. His story really encapsulates the instantaneous evaporation of the wealth effect that drove the Chinese economy for 2 decades.
Li Hui's perspective is crucial. He represents that aspirational middle class in a Tier 2 city. For years, he was told real estate was a guaranteed upward escalator.
The one sure bet.
The one sure bet. He purchased his apartment for 4 million RMB. Today, it's valued at 2.5 million, and there are no buyers. His financial security, the retirement plan, the kids' education fund, all of it just disappeared on paper.
But that's more than just a paper loss, though. That psychological shock fundamentally changes spending behavior. That's what reinforces the deflationary trap.
It creates a self-fulfilling prophecy. When a family sees 30–40% of their net worth just vanish, they don't just reduce unnecessary spending. They cut necessary spending. They hoard cash.
And everyone else is doing the same thing.
Liewei's neighbors are doing the same. They don't trust the stock market, they don't trust developers, and they don't trust the future. The only thing left that is perceived as absolutely safe is that government bond, even if the return is minimal. That fear is what drives the yield down to 1.83%.
So we have this massive flow of money into safe bonds, yet the central bank, the PBOC, has clearly been trying to inject liquidity into the corporate sector to kickstart lending. I saw the weighted average interest rate on newly issued corporate loans hit a historical low, something like 3.3% in March 2025.
Right.
That's down about half a percentage point year on year. On the surface, that looks incredibly accommodative.
And that low nominal rate is the crucial nuance that I think often gets missed by external observers. On paper, the policy is accommodative and rates are low. However, we have to talk about comprehensive financing costs.
Okay.
For businesses, especially the small and medium enterprises, the SMEs, and private companies, the ones that drive job creation, the actual cost of borrowing often includes a significant layer of non-interest expenses.
What exactly are those non-interest costs? What are we talking about here?
We're talking about mandated guarantee fees, charges from intermediary institutions, various administrative charges, and sometimes, hidden costs related to collateral requirements and approval times. These charges can often push the effective financing costs significantly higher than the publicly stated nominal interest rate.
Especially for the little guy.
Especially for smaller firms that lack the political access or guaranteed state backing of the large state-owned enterprises, the SOEs.
So the intended policy effect, this idea of cheap money stimulating growth, it's being negated by these hidden bureaucratic and structural costs. It's a policy drag.
Exactly. The low nominal rate benefits large SOEs that can bypass these fees, but the private sector, which is already nervous and facing margin compression, still finds borrowing relatively expensive or complex. The PBOC is aware of this disconnect.
So what are they doing about it?
Well, that's why a core part of their current strategy is strengthening bond market development and explicitly disclosing those comprehensive financing costs. The goal is to genuinely lower the overall corporate expense burden, especially for the vital private sector, and ensure that policy transmission actually works.
It's a complex and challenging environment in China. So let's turn to the flip side of the coin, Japan. It feels like they have finally, after 2.5 decades, found an escape route from the deflationary dungeon just as China is wandering in. The contrast is just astonishing.
It is genuinely jarring. Japan's CPI is currently around 3.6% as of March 2025. This is inflation that remains higher than the recent levels we've seen in both the US and Europe. To someone who lived through the last 30 years in Japan, this signals a fundamental and almost unbelievable shift away from that stagnation narrative. Inflation has returned.
And policy is shifting dramatically in response.
Dramatically.
And that shift is noticeable not just in the economic charts, but in the lives of ordinary citizens. You mentioned an anecdote about Emmy, a Tokyo housewife. She's navigating inflation, which is uncomfortable, but it signals that the economic system is finally functioning again.
Her perspective is critical because it captures the psychological turnaround. Emmy sees the price of soy sauce or imported goods ticking up at the supermarket, which is, annoying for the household budget. But she also sees a 0.2% interest rate on her previously inert bank deposits.
After decades of zero.
For decades, those deposits earned absolutely zero. Now her money's doing something. To her, the economy doesn't feel frozen anymore. It feels alive.
And this feeling is being driven by very concrete, very expansionary policy decisions. The fiscal stimulus has been massive.
Absolutely. The Takaichi cabinet pushed out an economic stimulus package of an approximately 200 trillion Korean won scale. Now, that's a massive injection of liquidity.
And it includes a direct cash.
It does. Direct handouts like 20,000 yen per child. This large-scale fiscal expenditure has a dual effect. It boosts aggregate demand, which fuels inflation, and it reinforces the government's commitment to permanently overcoming those deflationary expectations.
And crucially, the monetary policy transition is complete. The Bank of Japan, the BOJ, finally ended its 8-year experiment with negative interest rate policy in 2024.
Yes, the end of NIRP was monumental, but it wasn't the end of the journey. I mean, Morgan Stanley Research, among others, anticipates the BOJ will raise rates further in September 2025 from the current 0.5% level. This is a central bank actively managing expectations toward a positive, sustainable inflation target. It's a completely new regime for Japan.
How are Japanese households, who are famous for hoarding cash, reacting to this? To the end of stagnation and the return of positive interest?
Well, historically, Japanese households held an enormous 51% of their financial assets in cash and bank deposits. Compare that to only about 12% in the U.S.
An incredible amount of cash just sitting there.
Just sitting there, losing value. When inflation hits 3.6%, that cash loses real purchasing power quickly. Inflation acts as a tax on savings. So we are seeing a fundamental shift. Households are reallocating wealth away from inert deposits and into risk asset stocks, mutual funds, driven by the rational fear of losing value.
And the government is actively engineering this wealth migration with a crucial policy tool, the NISA system.
The Nippon Individual Savings Account, the expanded tax-exempt system they introduced in 2024, is the structural catalyst here. It acts as a massive long-term incentive for greater retail investor engagement.
It's being compared to the introduction of IRAs in the U.S.
And it's a very accurate comparison. It's like the IRAs in the U.S. back in the 1970s, which fundamentally changed American saving behavior. The NISA system is poised to unlock trillions of yen from bank accounts and redirect them into the capital markets. This will expand Japan's wealth management market significantly and provide the necessary patient capital for corporate growth.
And that migration of wealth, that supports the higher bond yield, signaling real economic activity, real confidence.
In direct contrast to China's fear-driven low yield, it's the same instrument telling two completely opposite stories.
What makes this entire economic inversion so compelling is that China is inheriting Japan's economic malaise precisely because it shares so many of the deep, systemic structural parallels that afflicted Japan back in the 80s and 90s.
The echoes are undeniable, even if the timing and the specifics are different.
Okay, let's unpack those shared foundations. When we talk about stagnation, we're really talking about a slow structural decline fueled by three major forces. Debt, demographics, and expectations. What is the most worrying similarity right now?
It has to be the demographic drag. This is a foundational, an unavoidable problem. Before Japan's credit peak, its average fertility rate was around 1.7. That decline was gradual.
Slow and steady.
Right. China's drop, however, has been steeper and faster. It fell below Japan's all-time low of 1.29 back in 2020. This is an unparalleled speed of demographic contraction for an economy that's still in the middle income trap.
And the pace of that decline means the pressure on aggregate demand just comes so much faster, right?
Much faster, and with less capacity to adapt. When you look at the dependency ratio, the proportion of non-working age people supported by the working population, China's data shows a higher uptick in pressure compared to Japan's historical data at a similar stage.
So it's a more acute problem.
It is a more acute long-term challenge to aggregate demand and future tax revenue than Japan initially faced, because the window for structural correction is rapidly closing.
Then there is the massive debt bubble. Both countries experienced this explosive credit growth preceding their crises, but the architecture of that debt is really different.
The credit to GDP path, the trajectory, looks eerily similar. Japan's private sector debt hit a staggering 350% of GDP in the late 80s. That leverage was primarily in the financial sector and large corporations.
And in China?
China's current non-central government debt ratio is around 250% of GDP, which is huge, but the leverage is concentrated differently. It's heavily concentrated in the non-financial corporate sector and, critically, local government financing vehicle debt. LGFV debt.
Explain why that LGFV concentration is such a fundamental danger, maybe even more dangerous than the financial sector debt Japan faced.
Well, the problem with LGFV debt is that it's opaque and politically constrained. LGFVs are basically shadow entities used by local governments to bypass central borrowing limits.
To fund vanity projects.
Often vanity projects or unsustainable infrastructure. This debt, which is often off-balance sheet and implicitly guaranteed, is incredibly hard to restructure because it's deeply embedded in the political fabric. Unlike standard corporate debt, which you can wipe out in bankruptcy, LGFV debt is politically necessary for local stability. It's very difficult to rationalize or centralize, making a clean resolution much harder than Japan's eventual bank cleanup.
And both of these factors, the demographics and the debt, they feed into that third shared pillar, the expectations trap, that negative feedback loop that converts short-term pain into long-term stagnation.
That is the most pernicious and the hardest to fight similarity. In 1990s Japan, weakening prospects for future growth and wages caused corporations to, rationally embark on a decades-long process of deleveraging. They just paid off debt instead of investing.
And consumers hoarded cash.
Exactly. Consumers, seeing wages stagnate, started hoarding cash. China is seeing the exact same outcome now. If consumers like Li Wei believe their 4 million RMB apartment is worth 2.5 million today and will be worth 1.5 million tomorrow, they will stop spending everything that isn't essential.
So it's a psychological freeze. If everyone expects tomorrow to be worse than today, they act in ways that ensure the economy slows down, validating that initial fear.
The expectation becomes the reality. Precisely. That downward spiral of reduced confidence, depressed consumption, and lack of corporate investment is the core mechanism of Japanification. And China is facing an immediate and severe version of that expectations crisis right now.
But China is not a photocopy of Japan. They've spent decades studying the Japanese experience, and they operate under a fundamentally different political and economic structure. So where does China fare better than Japan did in the 1990s? Where are their relative advantages?
There are three significant levers China possesses. First, and maybe most importantly, are the capital controls. China maintains arguably stricter capital controls than Japan did, particularly in the run-up to and during its crisis.
And the value of those controls is what exactly? What does that let them do?
It grants the PBOC substantial independent monetary policy autonomy. In a crisis, capital controls help smooth, short-term, procyclical capital flows. They prevent the sudden, massive flight of hot money that can destabilize the currency and force a central bank to raise interest rates just when the domestic economy needs lower rates.
The classic impossible Trinity dilemma.
Exactly. China has greater freedom to keep domestic rates low to fight deflation without worrying as much about catastrophic currency collapse.
Okay, second is the basic stage of economic development. China still has headroom for growth that Japan simply didn't possess in 1990.
That's a powerful mechanical advantage. China's GDP per capita is currently around $12,000. When Japan entered its crisis in the early 1990s, its GDP per capita was already around $30,000 in real US dollar terms. China is still a developing economy.
With more room to grow.
Much more. Lower urbanization rates, a higher need for infrastructure modernization. It suggests a significantly higher potential growth rate if reforms are executed successfully. Theoretically, this makes the deleveraging process less painful because growth can help inflate away some of the debt burden.
And the third, and perhaps most politically potent advantage, is the government's balance sheet.
Yep.
They are backed by massive state-owned assets.
This is their biggest structural advantage, I think. It's one that allows for sustainable debt expansion. China's government debt is underpinned by substantial state assets, primarily equity in state-owned enterprises, or SOEs. When you look at the consolidated balance sheet, China's broad government sector recorded net assets amounting to approximately 91% of GDP at the end of 2022.
91% of GDP.
And the equity in SOEs alone is valued at 119% of GDP.
So if the government needs to spend 5% of GDP on a fiscal stimulus, they can finance that by issuing debt, knowing they have this tremendous asset buffer to back it up, rather than risking a sovereign debt crisis.
Exactly. This structural advantage gives the central government ample room for sustainable debt expansion to finance recovery measures, like recapitalizing distressed banks or paying down LGFV debt. That was an option Japan didn't have to the same degree at the start of its crisis.
So China has significant strengths, but the flip side is that they face amplified risks, making their situation potentially much worse than Japan's 1990s crisis. Let's focus on the hyperbubble in property.
The property slump is expected to have a much larger, more systemic impact on China's real economy because the bubble was, well, it was historically unprecedented in size and depth.
The density and valuation metrics alone paint a terrifying picture.
They do. Consider the key metrics. China's urban residential vacancy rate hovers around 20%. That is more than double Japan's 9% rate in 1990.
20% vacancy.
More critically, house prices in major cities are far more stretched relative to income, around 28 times annual income in China versus 18 times in Japan in 1990. The property market, as we've seen with Li Wei, consumed a larger share of disposable income and wealth than in any prior major economic bubble.
And the linkage to the wider economy is tighter, embedding the risk deeper into the GDP structure.
Oh, much deeper. Residential investment share of GDP was 1.5 times higher in China in 2020 than it was in Japan in 1990. When you factor in upstream industries like steel, cement, appliances, and the crucial local government dependence on land sales, the collapse of property triggers a contagion that is structurally larger than Japan experienced.
And what about trust?
The collapse of trust, specifically the failure to complete pre-sold projects, the Evergrande situation being the most famous example, is destroying social cohesion and trust in financial institutions. That's an element that was perhaps slower to develop in 1990s Japan.
Finally, we have to look externally. Japan in the 1980s faced trade disputes, like the Plaza Accord, which was essentially a trade and currency negotiation. China today faces geopolitical competition that goes far, far beyond tariffs.
The external environment for China is exponentially worse. The current U.S.-China strategic competition is not merely a trade dispute. It extends across national security, technology, semiconductors, AI, energy, and defense. China faces higher domestic policy uncertainty.
From the regulatory crackdown.
Right, the crackdowns on tech and education. That, combined with this hostile external environment, severely subdues foreign direct investment. This combination demands a greater risk premium for holding Chinese assets, making external demand and technology access pressures arguably worse for contemporary China than they were for 1990s Japan.
The history of Japan's attempts to fight deflation is just essential reading for understanding China's current policy dilemmas. It's a playbook of initial mistakes followed by decades of increasingly radical monetary measures. What was the critical policy blunder Japan made immediately after the bubble burst?
Japan's critical blunder was what's known as the fiscal impasse, combined with regulatory forbearance. When the bubble burst, instead of aggressively deploying fiscal expansion, massive government borrowing to stimulate demand, the government initially held back. They were fearing runaway debt and political pushback.
And at the same time, they propped up failing companies.
Simultaneously, they tolerated what was called evergreening of loans. Banks were allowed to carry bad loans on their books, protecting so-called zombie companies that should have failed.
So they chose to preserve the unsustainable status quo rather than forcing a painful cleanup.
Exactly. And this prolonged the crisis. The lack of aggressive fiscal action meant corporate and consumer spending contracted, which entrenched the pessimism. The forbearance kept capital tied up in unproductive zombie firms, inhibiting true recovery and converting what should have been a short-term recession into long-term structural stagnation. This is the lesson China must avoid above all others.
That initial blunder set the stage for decades of monetary experimentation, moving from aggressive rate cuts to quantitative easing, and finally to the revolutionary concept of yield curve control, or YCC. Can you walk us through the mechanics of that policy escalation?
Sure. The BOJ started aggressively cutting rates in the 1990s, pushing the policy rate quickly towards zero. By 2001, they launched the first modern iteration of quantitative easing, or QE, targeting the quantity of reserves in the banking system. But the real game changer came in 2013 with QQE quantitative and qualitative easing under Governor Kuroda. This was shock and awe.
Huge asset purchases.
Massive open-ended asset purchases, 70 trillion per year. That went far beyond government bonds to include ETFs and J-rights. They were trying to shock the system into inflation.
But even that staggering monetary input failed to achieve the stable 2% inflation target.
It was a huge intervention, but expectations remained stubbornly deflationary. So in 2016, they adopted yield curve control, YCC. Instead of targeting the quantity of bonds purchased, the BOJ targeted the price of bonds, specifically setting a cap on the 10-year Japanese government bond yield around 0%.
What was the tactical genius of YCC? Why did that work where QE didn't?
Its genius was credibility. The BOJ committed to unlimited buying of JGBs to maintain that cap. Investors knew they couldn't fight the central bank's unlimited buying power, so the market rate stabilized near the target, even without the BOJ having to execute massive daily purchases. It successfully kept long-term borrowing costs low and stable.
Which was essential.
Essential for corporations and the government.
But the critical lesson here for China is that YCC successfully controlled the yield curve, the price of money, but it did not immediately solve the deflation problem.
That is the core takeaway. Core inflation remains stubbornly low. It barely moved above 0.5% for years despite the massive monetary accommodation. It took the combination of YCC, decades of stimulus, and finally, global supply chain shocks and cost-push inflation in the mid-2020s for Japan to finally achieve stable inflation.
And only now are they ready to normalize.
Only now, with CPI around 3.6%, is the BOJ preparing for an eventual full unwinding of YCC and expected rate hikes in September 2025. It took 30 years for the policy framework to normalize.
Now, Pivoting back to China, they've seen this movie before and they know the disastrous first act, the fiscal impasse. What is China's proactive, though deeply challenged, policy arsenal today?
Well, the prescribed path for China, learned directly from Japan's initial failure, is absolute clarity. The government must step in as the borrower of last resort. Since households are aggressively deleveraging, saving more, and corporations are debt-averse, investing less, the government needs to deploy massive, expansionary fiscal policy coupled with accommodative monetary policy.
This is critical.
It's critical to stabilize asset prices, especially real estate, and immediately restore growth expectations.
But policymakers are also balancing this immediate need with a critical push for structural reform. They don't want to just postpone the inevitable bubble pop.
That tension is the central political challenge. Policymakers are wary of using quick fixes, like a massive return to infrastructure spending or broadly easing real estate regulations. That would just preserve the long-standing, unsustainable structure of local government reliance on land sales. They understand that true long-term stability requires politically difficult structural measures.
What are those politically difficult measures? What do they look like?
They fall primarily under social welfare and demographics. China needs to build comprehensive social safety nets, reforming pension systems, healthcare, childcare to counter the demographic demand decline. If consumers weren't forced to save 70% of their income for retirement or health emergencies, they would spend more now.
And immigration?
They also need to be more open to policies, like targeted immigration, to address the rapidly shrinking working-age population. These are foundational changes that require political will over immediate economic gain.
Focusing on the immediate pain point, the property sector remains the anchor dragging the whole economy down. What are the specific policy recommendations aimed at minimizing this systemic drag?
The focus has to be on preventing contagion and ensuring social stability, especially given that mortgage loans account for 17% of total bank loans. First, they need to reduce the burden of non-performing assets, NPAs, on banks, perhaps through state-backed special-purpose vehicles to absorb bad debt.
And the social stability aspect, those unfinished projects.
That's paramount. They must ensure the completion of unfinished pre-sold projects. This is where the whitelist mechanism comes in. This policy allows certain projects to receive targeted state-backed financing based on their viability and social importance, injecting liquidity to finish construction and deliver homes.
Which restores homeowner trust.
Which is the goal. And if private firms are simply too distressed to continue,
then what?
State intervention becomes unavoidable. This means promoting state-owned enterprise buyouts or mergers of distressed private real estate companies to prevent systemic collapse. And crucially, as we discussed earlier, they need to fundamentally reform local government public finance. The historic reliance on land sales for revenue created the entire property bubble, and that unsustainable loop must be permanently broken.
Shifting to monetary policy, the PBOC has its own unique toolkit for guiding market rates, without relying solely on the blunt instrument of a federal funds rate like we see in the West. How are they steering the ship?
They primarily rely on the MLF, the medium-term lending facility, which was introduced in 2014. The MLF rate signals the central bank's medium-term policy rate. This system evolved from a purely quantitative tool, a way to inject specific amounts of cash, to one that primarily guides market interest rates by setting a price signal.
Okay, so MLF is the medium-term rate. What about short-term?
The 7-day reverse repo rate acts as the short-term policy rate, controlling day-to-day liquidity.
And this all funnels down into the actual rate businesses see, the loan prime rate.
Yes. The LPR reform in 2019 made it the primary market-based benchmark for all new loans. It's priced by adding a spread, which is determined by market factors, over the MLF rate. So while the PBOC doesn't directly dictate the LPR, by adjusting the MLF, they indirectly steer lending costs across the entire economy.
So they maintain a highly effective veneer of market-based pricing while retaining ultimate control.
Exactly. It gives the PBOC a distinct, centralized operational advantage compared to the BOJ's initial policy struggles decades ago.
This historic economic inversion, China deflating, Japan recovering, isn't just an internal problem. It fundamentally rewires global supply chains, commodity demand, and investment strategies. Let's start with China's deepening deflationary cycle. What is its global impact?
Well, the first and most immediate global shock is the commodity supercycle reversal. China's massive industrial demand was the primary driver of high commodity prices for 2 decades. Now, that weak demand, evidenced by the prolonged PPI decline, has sent shockwaves through global bulk commodity markets.
It's the world's largest consumer of raw materials cutting its orders, and that severely impacts the supplier nations.
Exactly. The raw materials and processing industries within China are contracting because they can no longer make a profit, with prices falling for 34 consecutive months. This immediately translates into plummeting prices for major global exports. Australian iron ore, which is essential for Chinese construction,
Brazilian copper.
Brazilian copper shipments, South African coal. We are witnessing a definitive reversal of the commodity supercycle, driven entirely by China's domestic freeze.
The human manifestation of this shift is the dilemma faced by the factory owners, like a Mr. Chen in Dongguan, who represents the industrial heartland. This is where deflation combines with geopolitical risk to crush margins.
Mr. Chen's story is a profound illustration of the structural shift. As an electronics manufacturer, he is selling his goods for less year on year because of the general price decline reflected in the PPI. His margins are crushed, exacerbated by ongoing geopolitical risks that increase shipping costs and add tariff uncertainty.
So instead of reinvesting, he's just trying to survive.
He was prioritizing survival. Instead of putting his meager profits into new production lines or machinery, he's doing something else.
And where is he putting his cash instead of new machinery?
He is joining the rest of the frightened Chinese middle class and buying those safe, low-interest government bonds. This choice signals a fundamental, systemic shift from aggressive global expansion to a deeply defensive crouch. The capital that used to fuel global manufacturing is now locked up in low-yield safety assets.
And that change reverberates throughout the entire global economy.
It does. But despite these internal struggles and global price shocks, China is still intensely focused on RMB internationalization. They are pushing the global use of the yuan even as the domestic economy struggles.
Why are they so focused on that now?
They're maintaining that long-term strategic push, driven partly by the realization that intensifying global trade frictions diminish the safe haven appeal of the US dollar. It creates an opening for alternative currencies. China is actively working to enrich the supply of high-quality RMB assets offshore, primarily by issuing RMB-denominated central bank bills in places like Hong Kong.
What is the purpose of issuing those bills offshore?
It serves multiple purposes. It helps soak up excess offshore RMB liquidity, it discourages speculative shorting of the currency, and critically, it helps establish a benchmark yield curve for the RMB outside the mainland, a necessary step for international investors. For instance, the PBOC issued RMB 120 billion worth of these bills in Hong Kong in the first quarter of 2025.
And are these efforts gaining traction in cross-border trade and finance?
Yes, selectively. In Q1 2025, cross-border RMB receipts and payments totaled RMB 17.1 trillion, which is a robust 17.2% year-on-year growth. Direct investments under the capital account also saw a 5.6% increase. So while the domestic economy struggles with deflation, the push for the RMB's global role continues.
Now we get to the necessary adjustment for global investors, the pivot away from China. Geopolitics, combined with China's deep systemic issues, is forcing a massive reallocation of global manufacturing capital.
This is the era of friendshoring and the China Plus One strategy. Global manufacturers are actively seeking alternatives due to tariffs, regulatory uncertainty, and political risks. And countries like Vietnam, India, and Mexico are emerging as the clear structural beneficiaries of this reallocation.
Give us some specifics on who is winning this reallocation battle in terms of raw investment data.
Vietnam, in particular, has seen significant gains. It has reported a 12% year-on-year increase in manufacturing output derived from foreign direct investment, focusing particularly on high-tech sectors like semiconductors and EV batteries. India, similarly, is gaining traction as a less volatile, rapidly growing supply chain alternative, particularly for U.S. and European markets.
So if the old investment thesis was China first and commodities high, what is the new positioning strategy for the era of deflationary China and recovering Japan?
Well, investors are advised to fundamentally reduce overexposure to assets that are structurally reliant on high Chinese demand. That includes commodities tied to Australian and Brazilian resource exports. Instead, the strategy emphasizes diversification into markets with strong structural and demographic tailwinds, primarily India and Vietnam, which are taking up the slack in manufacturing.
Are there specific sectors that thrive regardless of whether China is deflating or Japan is inflating?
Absolutely. The sectoral shift heavily favors strategic minerals, lithium, cobalt, rare earth elements, which are critical for the global green energy transition, regardless of where that transition capital is sourced. ESG-compliant sectors are also highly favored globally.
Things like solar and wind.
Companies like First Solar and Vestas Wind Systems are positioned to benefit from decarbonization efforts across all major economies, including Europe and the recovering Japan.
And finally, what's the ultimate hedge in this volatile, inverted world where risk seems to be hiding everywhere?
Gold. Trading near $3,500 per ounce, gold is emphasized as a critical dual hedge. It protects against U.S. inflation, which remains a concern in the long term, and simultaneously acts as a safe haven against the systemic deflationary and financial risks emanating from China. It is the ultimate asset for balancing the risks between inflation and deflation in a globally destabilized economy.
This deep dive has confirmed that the yield differential is merely the mathematical proof that China is inheriting Japan's deflationary and stagnation burden, just as Japan is finally finding its escape route decades later.
The crisis in China is deeply foundational. It is not merely cyclical. It encompasses overwhelming, politically difficult debt, rapidly worsening demographic pressures, and far more challenging geopolitical headwinds than Japan ever faced in the 1990s.
And while China does have more potent policy tools, massively subsidized by those substantial state assets and stricter capital controls, avoiding prolonged stagnation requires immediate, politically difficult structural reforms.
Right. Focusing on social safety nets and addressing the property crisis rather than resorting to those tempting, quick stimulus fixes.
This historic swap between Asia's two largest economies fundamentally rewires the global economic structure, from where capital is invested to where global supply chains are built to what commodities are priced at.
We are witnessing the end of the high-growth Chinese era and the beginning of a complex, bifurcated Asian financial future.
Regardless of whether China fully succumbs to Japanification, the China of tomorrow will be fundamentally different from the high-growth engine of the past 2 decades, demanding a closer look at its sustained impact on global stability.